This episode was produced using AI-generated voices and scripting. Okay, so OpenAI just wrote what might be the most expensive insurance policy in tech history. $20 billion. Not for chips they need today, for chips they might need if their current supplier decides to squeeze them.
And that's the part that makes this interesting, right? Because everyone's writing this up as OpenAI bets big on Cerebras, like it's a product decision. It's not a product decision. It's a negotiating tactic with a $20 billion price tag.
Okay, but hang on. You're saying they're spending more than $20 billion just to have leverage over Nvidia. That's an expensive bluff.
It's not a bluff if you actually follow through. And they are following through. They're getting an equity stake in Cerebras as part of this deal. That's not how you buy chips. That's how you buy a company's roadmap. You're locking yourself into their future, and you're making sure that future actually exists.
Which is wild because Cerebras is simultaneously preparing to go public at a $35 billion valuation, maybe higher. So OpenAI's equity stake could end up being worth, I mean, that's a real financial position, not just a procurement contract.
Exactly. And nobody's saying this. The IPO changes the math entirely. Cerebras filed confidentially they're eyeing 35 billion plus. If OpenAI took that equity stake before the IPO, which it sounds like they did, they're sitting on an asset that could appreciate significantly on day one of trading. This deal might partially pay for itself.
So it's a chip deal, that's also a venture investment, that's also a supply chain hedge. That's a lot of things for one transaction to be.
Welcome to AI infrastructure in 2025. Nothing is one thing anymore.
Alright, let me push back though. Cerebras makes wafer-scale chips. One giant chip per wafer. They've been doing this for years and they're still not anywhere close to Nvidia's market position. Why does $20 billion from OpenAI change that?
Because the bottleneck was never the technology. Cerebras has had interesting silicon for a while. The bottleneck was demand certainty. No foundry scales production for you, no ecosystem builds around you, unless someone credible says, I will buy a mountain of these. OpenAI just said that. $20 billion of that.
That's the whole game right there. You can't be a chip company without customers, and you can't get customers without being a chip company.
Right. And look, this is where TSMC matters. TSMC just reported revenue up over 35% year over year. AI accelerator revenue more than doubled. They're the ones actually fabricating these chips. Cerebras doesn't have its own fabs, so when OpenAI commits $20 billion to Cerebras, a big chunk of that is really flowing through to TSMC.
Wait, seriously? So TSMC benefits whether it's Nvidia chips or Cerebras chips?
That's not what's happening in the narrative, but it's exactly what's happening in reality. TSMC is the house. The house always wins. Nvidia winning, Cerebras winning, TSMC doesn't care. They're fabricating for both. Their capital expenditure guidance for 2025 is between $38 and $42 billion. That number tells you everything about where the actual confidence is.
38 to 42 billion in capex from the foundry. I mean, that's more than what OpenAI is spending on Cerebras.
And TSMC's gross margins came in over 58%. They have pricing power that would make a drug company jealous. So here's my actual concern with the OpenAI Cerebras deal. Even if Cerebras designs great chips, TSMC capacity allocation is the real constraint. And Nvidia is TSMC's biggest AI customer. So Cerebras is competing for fab time against the incumbent.
Which means OpenAI might be spending $20 billion on chips that are bottlenecked by the same factory that makes their competitors' chips.
Now you're getting it.
Okay, so that's depressing. Let me ask the other obvious question. Who does this actually help? Like, is this good for the AI ecosystem broadly, or is this just OpenAI consolidating power?
Oh, and the people who say competition is always good aren't thinking it through. If OpenAI is the anchor customer that makes Cerebras viable as a real Nvidia alternative, then yes, other companies eventually benefit from having a second option. But in the near term, OpenAI has preferential access to those chips. They have an equity stake. They're not doing this to help Google.
Speaking of Google, Google and CoreWeave just raised $6.7 billion in bonds. Like, investment-grade bonds for AI infrastructure. That feels related?
It's extremely related. Google sold $5.5 billion in bonds across multiple maturities. CoreWeave did $1.2 billion, and the spreads were tight. Google's long bond came in at around 50 to 55 basis points over treasuries. That's the market saying, we believe AI infrastructure is as safe as, like, a utility.
Is it though?
No, and that's what keeps me up at night about all of this. We're pricing AI infrastructure debt like it's guaranteed to generate returns for 30 years. Google's longest tranche was a 40-year bond. 40 years, and a technology that's existed in its current form for maybe 3.
40-year bonds for AI? In 2025, someone's going to be holding those in 2065 and either feeling very smart or very stupid.
And CoreWeave is even wilder. They're a GPU cloud company that barely existed a few years ago, and they're issuing investment-grade bonds. The demand was there. That tells you the capital markets have decided AI compute is real infrastructure, not speculative tech. Whether they're right about that is a completely different question.
Okay, but hang on. You said the TSMC numbers back up the demand story. Revenue up 35%. AI revenue doubled. If the demand is real,
The demand is real today. I'm not disputing that. What I'm disputing is the assumption baked into a 40-year bond that this demand curve just keeps going. TSMC's results are a snapshot, a really good snapshot. But there are scenarios where inference gets dramatically more efficient, where you need fewer chips per query, where the capex cycle peaks and
where all these billions in infrastructure become stranded assets.
exactly. And the Cerebras deal is interesting in that context because Cerebras' whole pitch is efficiency. Their wafer scale approach is supposed to be better for inference workloads. So OpenAI might be hedging against a future where you need different chips for different parts of the AI stack.
Training on Nvidia, inference on Cerebras.
That's one plausible split. And if inference becomes the bigger workload, which it almost certainly will as these models get deployed to billions of users, then the Cerebras bet starts looking less like diversification and more like getting ahead of a platform shift.
That's a much more interesting read than OpenAI doesn't want to depend on Nvidia.
It is, and nobody's framing it that way because the Nvidia rivalry narrative is sexier. But the real question isn't can Cerebras compete with Nvidia? It's is the future of AI compute heterogeneous enough that both architectures win for different use cases?
So wait, let me circle back to the valuation thing. Cerebras at 35 billion. OpenAI just raised at what, 300 billion? And OpenAI is committing 20 billion to Cerebras. That's the scale of these numbers has gotten completely unmoored from anything I can compare them to.
The actual number is that OpenAI's total commitment is more than 20 billion. The articles are careful to say more than, which could mean 21 billion, could mean 30. We don't know. But even at 20, that's more than half of Cerebras' expected public market value going to Cerebras from a single customer. Name another industry where that happened.
Defense contracts, maybe, like when the Pentagon picks a fighter jet program.
That's actually, yeah, that's the right analogy. This is defense procurement logic applied to AI. You pick your supplier, you fund their existence, you get preferential terms, and you accept that you're now in a long-term entanglement that neither side can easily exit.
Which means if Cerebras underdelivers, OpenAI can't just walk away. They own equity. They've committed the capital.
And if Cerebras overdelivers, OpenAI has a financial windfall plus cheaper compute. The asymmetry is actually pretty good for OpenAI. They can afford to lose 20 billion. I know that sounds insane, but at their valuation and with the capital they're raising, it's a manageable bet.
Can they, though? They're still not profitable. They're burning cash on training runs. They just restructured their entire corporate governance. They can afford it, assumes a lot about future fundraising.
There. And this is where the bond market stuff connects. If Google and CoreWeave can raise billions in bonds at tight spreads, the assumption is that the entire AI ecosystem has access to cheap capital right now. OpenAI is operating in a window where money is almost free for AI companies. The question is whether that window stays open.
Because you said something 10 minutes ago about TSMC's capex being 38 to 42 billion, that's them betting the window stays open too.
Right, and TSMC is probably the most conservative major player in this space. They don't build capacity on speculation. They build it on committed orders. So when they guide capex that high, they have line of sight on demand. That's genuinely bullish.
But it's bullish for TSMC, not necessarily for Cerebras or OpenAI or anyone else in the chain.
Correct. TSMC captures the margin. Everyone downstream fights over what's left. And this is, I keep coming back to this, the structural problem with the Nvidia alternative thesis. You can replace Nvidia. You cannot replace TSMC. Not in this decade. There's no alternative foundry at the leading edge.
So, OpenAI diversifies away from one monopoly supplier and remains dependent on a different monopoly supplier.
Yep, they're choosing which choke point to live with. Nvidia's is a design choke point, proprietary architecture, CUDA software ecosystem, market power. TSMC's is a manufacturing choke point. They're the only ones who can build these chips at scale. OpenAI decided the design choke point is the one they can root around.
Which is probably correct. Like, software lock-in feels more dangerous than manufacturing dependency, because at least TSMC sells to everyone.
I think that's right. TSMC is a neutral arms dealer. Nvidia is not. Nvidia has its own cloud ambitions, its own model training partnerships, its own strategy for the AI stack. When your chip supplier is also kind of your competitor, that's when you start writing $20 billion checks to someone else.
Okay, here's what I keep wondering though. Does Jensen Huang care? Like, Nvidia's data center revenue is enormous. Does losing one customer to Cerebras actually matter to them?
It matters for the narrative more than the revenue. In the near term, no. Nvidia has more demand than they can fill. Every chip they make gets sold. But if OpenAI proves that Cerebras works at scale for inference, and remember, OpenAI is probably the single highest profile AI workload on the planet. That gives every other hyperscaler permission to diversify too.
That's the domino theory of chip procurement.
And it's real. Google already designs its own TPUs. Amazon has Trainium, Microsoft has Maya, but none of those are merchant chips. They're captive, built for internal use. Cerebras is the first credible merchant alternative that could serve the broader market. If OpenAI validates it, Cerebras could end up serving companies that can't afford to design their own silicon,
Which is most companies.
which is almost every company. And that's why the IPO at $35 billion might actually be cheap. If Cerebras becomes the non-Nvidia option for everyone who isn't Google or Amazon, the total addressable market is massive.
Wait, you just said 35 billion might be cheap? For a company that, what are their actual revenues?
They haven't disclosed full numbers publicly because the filing is confidential. But the $35 billion is the floor of what they're targeting for the IPO. And with a $20 billion committed customer in OpenAI, the revenue visibility is unlike anything a chip startup has ever had going into a public listing.
Fair. Having your largest customer publicly committed to more than 20 billion that's a cheat code for an IPO roadshow.
It's the best slide in the deck. Our biggest customer is the most important AI company in the world. And here's their purchase order. Every mutual fund manager in the room writes a check.
So let me try to tie this together. We've got OpenAI spending 20 plus billion on Cerebras chips and equity. Cerebras going public at 35 billion plus. Google and CoreWeave raising 6.7 billion in bonds for AI infrastructure. TSMC posting monster results with AI revenue more than doubling. What's the through line?
The through line is that AI infrastructure has entered a phase where the capital commitments are so large that they're reshaping the financial system around them. These aren't tech deals anymore. They're infrastructure plays. Bonds, equity stakes, procurement contracts that look like sovereign wealth fund investments. The money is moving at a scale it's creating its own gravity.
And if the AI demand curve flattens?
Then you have the most expensive lesson in sunk cost economics since the fiber optic build-out of the late 90s, which, honestly, turned out fine eventually. We use all that fiber now. It just destroyed a lot of investors on the way there.
So the infrastructure gets built, it eventually gets used, but the people who paid for it might not be the ones who benefit.
That's the pattern. And it could happen again. But the difference this time, and I'm genuinely uncertain about this, is that the demand side is already enormous. ChatGPT has hundreds of millions of users. Google is embedding AI into search. Microsoft is putting it in every product. The fiber build-out happened before broadband demand materialized. The AI build-out is happening alongside real usage.
That's actually a meaningful distinction.
It is. Doesn't mean everyone wins. Doesn't mean the valuations are right. But it means the base case isn't, this was all a fantasy. The base case is some of these bets pay off spectacularly, and some of them don't.
And OpenAI's bet is that they want to be on both sides of that. Nvidia for what works now. Cerebras for what might work better later. Equity upside if Cerebras takes off. negotiating leverage either way.
That's the cleanest summary I've heard. They're not abandoning Nvidia. They're making sure Nvidia knows they could, and they're getting paid to do it through the equity stake. It's, I mean, it's ruthlessly well structured if you're OpenAI.
Unless Cerebras can't deliver?
Unless Cerebras can't deliver, which is a real risk. Wafer scale is hard, yield is hard, scaling production is hard, and they have to do all of that while going through an IPO, which is its own enormous distraction.
That's a lot of hard things at the same time.
It is. The $20 billion buys you a lot of smart people working on hard things. And that's probably what OpenAI is really buying. Not just chips, but the assurance that someone will keep solving these problems for them even if Nvidia decides to play favorite.
All right. $20 billion to keep your options open. Only in AI does that sound reasonable.
Give it a year. It'll sound cheap.